Once again, thank you everyone for coming in. As was mentioned a minute ago, this has proven to be a very interesting time to have this presentation. And I have to say that this has proven to be perhaps the most challenging presentation to prep for that we've had in some time. Because right now it feels like if you prep for a meeting more than about 30 or 40 minutes beforehand, your information is completely out of date by the time you start speaking. So the way that everything looked and the way that the world looked a week ago is significantly different than it does today. But we thought that this was a good time to just come on and just do a little bit of an explanation of some of the more notable events that have been going on in the last few days, and also speak a little bit about our thoughts and how we are kind of digesting some of these things, and what things we think are a little more significant, what things may be a little bit more noise with all of this stuff going on. So we have a lot of people on today. Appreciate you all coming. A lot of people are on from StraightLine and from Skyview, and several of them will speak here as we go through this. So, but I'm going to launch in with just an explanation of probably the most noteworthy thing that's been happening in the last few days, and that is the challenge that has come with our banking sector, specifically our regional banking sector. So a lot of you, I am sure, have been hearing and reading about the collapse of several banks, the biggest one being Silicon Valley Bank, which, as its name obviously suggests, was out of Silicon Valley out in California. And there have been some pretty extraordinary measures taken in the past few days to shore up the not the finances. This is one of the things that we're going to talk about, but shore up the depositors of Silicon Valley Bank. The other one was Signature Bank that went under. We're going to talk about them in a minute as well. But the Fed and different government agencies and the Federal Reserve have stepped in a variety of ways to backstop these institutions, and more specifically, the depositors at these institutions. Now, I know a lot of talking heads right now that are arguing over the definition of the word bailout. And there's word backstop and bailout are being used depending on the context of the conversation, in some cases interchangeably. So one of the things that we want to talk about, and I think that this is a theme, we've been getting a lot of questions naturally, is this a repeat of 2008, okay, of the financial crisis that was really sparked by a lot of the weaknesses that came up from the big banks. There are a couple of significant differences with what's happening now and what was happening 15, 16 years ago. And one of them is that with this particular institution, talking about Silicon Valley Bank first, this bank was not brought down by incredibly complex financial instruments that were behind the scenes and things that could only be defined by a handful of people talking about how brilliant they were when they created them, and in the end it was a bit of an emperor has no clothes type moment. Silicon Valley Bank, it was invested in really boring stuff. It was invested largely in treasury notes, treasury bills, but they were invested in a very particular area of the treasury notes, or specifically the length of time of the treasury notes, that have that really were subject to a lot of the problems that have been happening in the bond market over the last year and a half. So let me take a step back and briefly talk about that bank and the history of that bank. That was a very specialized institution that was incredibly focused on tech companies and startups, okay, particularly venture capital backed startups, okay. And from what we have learned and from what we have heard over the recent past, is that if you were in the business of startups, especially out in California, this was the bank you almost had to work with. They were the absolute best at it in the industry. But when you think about the companies that they were dealing with, these are companies that were getting a lot of money, often from venture capital firms, and they were using a lot of money. But they had especially over the last 5-10 years, they had an enormous amount of money thrown at them, and they had to do something with it. They had to put it somewhere because they didn't use it all at the same time. So a lot of that ended up in Silicon Valley Bank, which was also involved in the financing of these institutions in other ways. And to just put some numbers on that, I have it right here. Silicon Valley Bank had $56 billion in assets in mid-2018. By the fourth quarter of 2020, they were at 100 billion in deposits. Okay. By the end of last year, they were at 200 billion. So we're talking about a bank that had quadrupled in size in essentially less than 5 years. Now, when a bank takes in money, this is true for any bank, when a bank takes in money, that is weirdly sometimes that is a liability for the bank. What is an asset to you and I, cash that we have, when it goes into a bank, the bank essentially owes it to you. That is a liability for the bank. The assets of a bank are their loans, which again are liabilities to us, but their assets are loans that produce income and other investments that produce income. So when they took in all this money, they had to do something with it. So they lent out a bunch of it, but with all the stuff they couldn't lend out, they bought really safe and really conservative things like treasury bills. The problem and the reasons for this are varied and will, I think, be coming out in the post-mortem. But the problem is that they bought a significant amount over the last few years. They bought a significant amount of long-term treasury bonds, okay, 10, 15-year notes. Now, at that time, over the last few years, and everybody knows this, interest rates were basically at zero. The returns on those long-term bonds were extraordinarily low. They were higher than short-term bonds, but still extremely low. But they bought all of these things, okay? Now, that's perfectly fine, and on paper is very safe. Well, why did it go bad? Okay, well, here's the basic reason. At the early part of last year, when interest rates really started to rise, the value of those bonds went down, okay? And if you remember, bond values and interest rates generally move in opposite directions, okay? And the longer the term of the bond, the more vulnerable they are to those movements. So what happened is the face value of those bonds went down pretty significantly. Now, that's not necessarily a bad thing. By itself, that's okay, because as long as you don't have to sell those bonds, you don't realize those losses. But on paper, there were huge losses on their balance sheet, okay? Now, what happened is when things kind of peaked out for that bank, which is the end of last year, $200 billion in assets. Well, we all know that things have been getting a little bit ugly. Especially venture capital firms have pulled back on their investments. They've pulled back on the flow of cash that has gone out to these companies. So these companies they have their expenses. They have payroll, and they have light bills, and they have all their things they need to do. So when the venture capital money slowed down, they had to start withdrawing money from the bank. By itself, not a big deal, not unlike what you or I would do in our own situation. Well, in the case of Silicon Valley Bank, $40 billion was withdrawn in basically 2 months. Now, this was not because of panic in most cases. This was just because of natural, the natural cash burn of these companies. But with that amount of distribution, the banks had to start selling their assets to free up the money so that they could send it out to people who were requesting distributions, right? Well, that means that they had to start selling all of those bonds that were now at a much lower price, and it started to create a hole, okay? And that got worse and worse, and it got worse pretty quickly. And what they did, and I think this is also probably something that will come out in the postmortem, is that they waited quite a long time to try and figure out another way to get their assets. So fast forward to last week, and on Wednesday of last week, they publicly announced that they needed some more financing, and they tried to sell about $1.9 billion worth of stock. And then the market went, wait a minute, why are you trying to sell stock right now? Why are you short of cash? And then everybody started to get very suspicious. The value of the bank started to go down. People started to sell the stock. People started to say, well, wait a minute, this bank isn't healthy. We need to pull our money out too, which just turned into a spiral. Then they had to sell more assets and lower and lower prices. Now their stock is worthless. And within 36 hours, it was gone. Okay, that's how long it takes. This was at the end, this was nothing more than a good old fashioned run on the bank. Okay, too many people, I don't care what bank it is, the best bank in the world, if too many people want their money out at exactly the same time, the banks can't handle that. And that's precisely what happened. It happened in a stunningly short period of time. So what they did really was, I mean, again, we can go on all day about what could have caused this or what could have prevented this. But at the end of the day, what happened was actually very simple. Their assets behind the scenes were not worth what they should have been, and they were clearly betting that they wouldn't have to sell those things. But when they had to sell them, and they had to sell them too quickly, that death spiral happened, and it happened within a day. The value of the company went from essentially $160 billion in market capitalization to zero in essentially about 24 hours, which can happen. Okay, so normally what happens when a bank fails, and this is what was significant, normally what happens when a bank fails is that we all have FDIC insurance, right, on our own bank accounts. And the FDIC steps in normally for deposits that are up to $250,000, and it's $250,000 per depositor per institution. Well, our friends at Silicon Valley Bank, because of their specialty and because of the fact that most of their account holders were either big corporations or very wealthy tech executives, more than 93% of their accounts and their assets in the accounts were above the $250,000 account-based limit, which so more than 150 billion out of their remaining assets at that time were essentially not backed up by the FDIC, meaning that if the companies had lost access to them, it's just gone. Okay, they wouldn't have been able to support their operations. They wouldn't have been able to make payroll. This would have been, it could have easily been, and technically still could be, but without some intervention, this could have been a death blow for a lot of companies, particularly in those industries. So last weekend, by the way, this whole explanation that I'm talking about sounds like it took months and years. That we're talking about a couple of days, all right? But over the weekend, the government officials, Federal Reserve officials all got together, and what they did, which is again, different than bailing out the companies, is they used funds from the FDIC essentially to guarantee the depositors. Okay, that's probably the biggest difference with this versus what happened in 2008 when the government stepped in to shore up the banking system. At that time, they had to shore up the companies. Okay, they put billions and billions of dollars of funds into these banks, regardless of, in some cases, regardless of their health. But they had to protect the companies. In this case, they're not protecting the company. Silicon Valley Bank is gone. Signature Bank is gone. They have been taken in, assets seized, new entity is set up, but the depositors are backstopped. Okay. So again, when the politicians and the talking heads start to argue about was this a bailout or not, you can define it however you want, but they did not they did not backstop the value of the companies, and they didn't use taxpayer dollars to do it. They used funds from the FDIC, which come from other banks. Okay, big difference from 08. So I've been talking about Silicon Valley for most of the time here, but the other one that was rather significant was Signature Bank. This is going to be a much shorter explanation, and I don't mean to just be flippant about it, but the difference with Signature Bank in New York, another big bank, but Signature was heavily exposed to the cryptocurrency space. They were a fairly specialized player, largely exposed to not necessarily to cryptocurrency itself, but to a lot of players in the cryptocurrency world. And that was their niche. That's what that's how they marketed themselves. Well, we all know what's been happening in crypto. And they were also exposed, from what we understand, fairly heavily to FTX, the crypto exchange that imploded rather spectacularly a few months ago. So they have been reeling from that for some time. But that was, I think, a casualty much more so of the downfall so far of many players in the crypto industry. So everything that you've heard so far is what we prepped for last night. What we had to add in this morning was a little bit of language about a new issue. If anyone has looked at the market today, it's not the prettiest day of all time, but there's some noise coming out about Credit Suisse, which is obviously not a US-based institution, but there's some concern now about some of their finances, and that is because they reported they had identified, and I quote, material weaknesses in controls over financial reporting. Now, that's not a phrase that anyone likes to hear, especially when it's said by the institution. But we don't know exactly what that means yet, but the market is definitely questioning that. They were down 20%, at least as of an hour or two ago, today. So there's more that will be coming out from them. And the other thing that was kind of unique about this one is that their largest individual shareholder, which just so happens to be the Saudi National Bank, has said publicly that they would not buy any more of their stock, which is also being interpreted as a sign of weakness. Now, they are not saying that they won't buy their stock because they don't want it, but they're saying that it's because they already own 9.88% of their outstanding stock. And if they go over 10%, it subjects them to a whole other host of rules and problems and disclosure and everything else. So they're basically saying, hey, we can't help, and we can't be your backstop any more than we are. So it's a little too early to say what the fallout is going to be from Credit Suisse. That one appears to be very much unrelated to, at least as of this moment, and it is 2:28 p.m. Eastern time on March 15th, 2023. So by 2:47, it could be different. But as of this moment, it does not appear to be directly related to the issues that we're dealing with in the regional sector over here. Okay, so real quick, going back to the US based issues, um, there's a lot of questions naturally about whether this is going to be contagious, and whether these issues will be will be seen by other institutions. No one knows for sure. There are other banks that are concentrated. There are other banks that could theoretically pose some risks to the overall system. However, these cases were pretty specific. And it is our expectation at this time that doesn't have a high probability of infecting the rest of the system, at least not with those particular problems. The only real concern is about the confidence in the overall system. Okay, a lack of confidence in the system can be extremely contagious. What I think, though, by the government's actions, by the Federal Reserve's actions, it has done a lot to calm nerves. The nerves are still pretty frayed, but I think from where we could be, even over the last couple of days, and we've seen some big drops in a lot of banking stocks, but a lot of them came back sharply yesterday. So high volatility, and we expect that to continue. But at this stage, we don't believe that there is any reason to expect some large scale run on the entire financial system that would threaten things at a fundamental level. Okay. We just believe that those issues are unique enough to those institutions that they can stay contained. And in some ways, it's actually a bit of a lesson on diversification itself, right? These are financial institutions that were diversified in one particular area and made decisions in a very particular way. And it may be a lesson for the importance of diversification over time. So anyway, we won't go too far down that road. But this is going to be dissected. This is going to be a regulatory, investigation. You're going to hear a lot of things over the next few days and weeks and months. There's no question that banking regulations are kind of on a pendulum, right? There were times when they were very weak. There are times, especially after 2008, that they were very strong. The pendulum swung back a bit in 2018 and 2019, and it reduced the regulations, or excuse me, the number of institutions and the size of institutions that were subject to these stricter regulations was reduced a few years ago. I think that it is a virtual certainty that pendulum will swing back a little bit in that direction, and these increased rules will apply to institutions that are a little further down the chain from the big giant names that we all know. So I think that will be an outcome of this, and how that impacts things like investments in those banks, time will tell. So I want to shift gears a little bit, but still in the same thread. Many of the people on this call right now, via StraightLine, have accounts at Charles Schwab. And there have been some questions about Charles Schwab over the last few days. And the name Charles Schwab has been in the news quite a bit, if anyone has looked. Now, this is one time where we need to distinguish between Charles Schwab, the person, and Charles Schwab, the company. Chuck, I'm going to call him Chuck. I don't know him, but that's actually what he calls himself. So Chuck, which is going to make it easier to differentiate the two. Chuck, the man, has had a bad week. Chuck, the man, was invested personally, from what we understand, pretty heavily in Silicon Valley Bank stock, not a depositor, a stockholder. And he lost a significant amount of money when that stock went to zero. Also, the value of, with all of the financial institutions, as their shares came down, and especially on Monday, they've come back significantly since. But Chuck the man obviously still holds a lot of stock in Schwab the corporation. So Chuck the man lost about $3 billion in about 2 days, and it's big enough that it has become a news story. But the way that Chuck the man is invested is very different than the way Schwab the company is invested and organized. Schwab the corporation is, by all, we've investigated this in many different ways, not just in the last few days, but over the past, however long it's been, I don't even know, 16 or 17 years that we've been working with them. And we want to say very clearly that we do not have any concerns about Schwab the corporation. Schwab does have a bank arm. That bank is extremely different than the institutions that we've been talking about today, and the institutions that have faltered. They are really, really boring, and they pride themselves on being very boring. They also do not have anything close to the level of concentration that those other banks did. In fact, more than 80%, and this is very common in most banks, but more than 80% of their depositors are under the FDIC limit. Okay. Also, Schwab Bank is not the same as the Schwab is the custodian, where our accounts are all held. Those assets are not commingled. Okay, so we're not worried about Schwab the bank, but even if we were, Schwab the bank is not the same as Schwab the corporation. Okay, they have access to, and they've been very public about this, they have access to huge amounts of liquidity, and are positioned in a very, very conservative way that is very, very different than the other institutions. Okay, so a lot of people have called our office about this in the last couple of days. It's very understandable, but we wanted to put out some reassurance that that we are not concerned about Schwab as a company. Okay. So with that, I'm going to switch gears just a bit. Excuse me. And you know what we are talking about, and as far as the market goes, I'll come back on in a minute to kind of sum up these things. But what has really been the driver of markets for the last year or so has been the Fed, has been its march upwards with interest rates, and you know, the expectations for how high rates will go. And that answer has changed, most likely, has changed very significantly over the last few days. So to tie some of these aspects together, I'd like to invite in Steve Turry, or and I saw Andy Melnick is on the call. I think he's still on here. But Steve, if you wouldn't mind popping on.
Sure.
There he is.
Hello.
I'll let you address that one. Mainly, we're just looking at you know, how the expectations of interest rates in the both in the real short term, you know, say the next meeting coming up next week, and how the expectation for interest rates have changed over the course of the year with all of the fun that we've been having over the last few days.
I like how you define fun there, Mike, but thank you for having Andy and me on the call. It's a pleasure seeing everybody, and look forward to your questions. And regarding interest rates, that's the key thing. We're really monitoring what the Federal Reserve is going to do. So if we kind of look at it two ways, one is, what does the market think? Market's not always right. And then what do some of the, you know, analysts out there who are pretty insightful think as well? So if the market right now thinks the Fed is actually going to cut rates by the end of this year, much more so than, you know, we thought even a month or two ago, and that is being reflected in the fact that you can see those different instruments that Mike was talking about. Those treasuries have been the yield on those treasuries has been coming down. That means the price is going up. as the as investors, one, want to go to safety, and two, expect rate cuts really, and so want to try to lock in a little bit of a higher rate. And so then there, like some of the research firms, and I'm going to steal something from Andy Melnick. Andy was the head of research at both Goldman Sachs. He led that team, as well as the head of research at Merrill Lynch. And so if we look at what Goldman Sachs now is forecasting coming up in the next Federal Reserve meeting, Fed Open Market Committee meeting, is that there will be no increase. And Bank of America, Merrill Lynch, is assuming about a 0.25% increase. And Andy always says that both are probably right. I agree with both. So it's probably after today and what's happening with Credit Suisse, what's happening with Republic Bank, what's likely to happen with other regional banks as this plays out, that it's probably more likely no increase. And why is that? Those regional banks are really, really important to the growth of our economy. They do things that the larger banks don't, like they give mortgages. Some of the larger banks do too, but in general, they really help stimulate economic growth. And in fact, Goldman Sachs came out today forecasting a pretty significant lower increase in economic growth. They took it down by 0.3%. So now they're forecasting for 2023 approximately just over 1% GDP growth. So that is because we the impact that this chaos is having on the regional banks will filter its way through the economy. That'll eventually filter its way through employment. So and we'll see less economic activity, which at the end of the day is what the Federal Reserve was trying to achieve with increasing rates. I don't think this was part of their design, but in a way, their need for increasing rates may not be as necessary as it was before the issues that we are now confronting with these regional banks.
Yeah, I think it's a very important point. You know, and I want to just expand on that just a little bit. You know, just to say what Steve said maybe a little bit differently. You know, why has the Fed been raising rates? Well, you know, we've had inflation, right? And the Fed is trying to bring down inflation, and there are several tools that can be used for that, but how strong any of them can be are debatable, because it's an interconnected series of factors where you pull one lever and you affect 50 others. But at its core, the Fed is trying to, it's weird to say it this way, but the Fed is essentially trying to hurt the economy. Okay, the economy, and this is, I realize what I'm about to say right now, and I realize that this is not going to sound wonderful to people, but the economy, part of the problem has been too good. Okay. People are spending money. People are out there doing it. They might be doing it through gritted teeth and they're not happy about it, but the actions that have been taken have really not slowed down the economy enough to bring the price increases back down under control, right? And you know, there are a lot of things that can cause inflation. One of them is right here. It is the expectations of people. It can very much be a self-fulfilling prophecy. So if the expectation is that prices are going to keep going up, prices in many ways will keep going up. That's not the only reason. But one way to slow down economic activity, I hate to say it, is when people are a little bit scared. And if this is something that is causing people to kind of take a pause, it actually could have that effect. So Steve, I think you're absolutely right. It's not that, I don't think that the Fed was sitting there going, hey, I know how we can do this. Let's knock out some banks. Okay, that's not, clearly that's not what they wanted to do. But this, because of what it has done to asset prices, especially bond prices behind the scenes, may very well have accomplished their goals. And I think that we will see a slight change in the tone of what the Fed says, in talking about how, well, yeah, this is really what we meant. They're going to say it a little more professionally than that, but essentially what they're saying is, well, yeah, this was our goal. We wanted it to happen a different way, but we got the same thing. So we probably don't have to continue down this road, because if they do, what they might inadvertently do is create other chaos in the financial system. So it's a very weird time to be balancing all of these factors together, and that's really what this is. It's a balancing act. And remember what I said. They have more or less one lever they can pull. This is a perfect example of how those ripple effects can come out in ways that were not necessarily intended. So what does that mean? The question that naturally follows an explanation like this is, okay, great. So what are you doing about it? What are we doing about it? How should we be making changes? Should we be making changes? And, I think the best way to say this, it's probably not the definitive answer that I think some people might hope for, but I think if anyone tells you that they absolutely know exactly what's coming in the next few days and weeks and months, I think the best thing you can do is to stop listening to that person. That's not to say we have no idea. It's just to say that the specifics of this are working themselves out, sometimes in a time frame of hours. But what it does is really, and what we are seeing now it really is not that different from what we have been saying we expect. Volatility. Okay. Did we say, we weren't saying, oh, we knew this was going to happen, this was going to happen, and this was going to happen, but the outcome of this is really no different than what we have been expecting to go on. So I think, I think that is, that's still going to be a theme. We are having meetings really on a daily basis, talking about these things, deciding whether or not there are changes that need to be made. But here's the other thing that's important for you to know. Over the course of probably the last year and a half, we have been taking steps that have incrementally prepared for some of this volatility. Now, that does not mean that does not mean that it was designed to miss out on the full blast of a downturn. That's not how the changes have gone. But we have been taking steps that have reduced exposure to some of these areas and increased exposure, particularly in our Schwab accounts, to things like treasuries, short-term treasuries, which are great right now. They're paying rates that we haven't seen in decades. So this is the continuation of a process that has been in place for a long time, and we are constantly refining that process to see if further changes are needed and whether or not there are things that can be positioned differently. Okay, so I know that's not a specific answer to the question, but just know that this is very much a continuous process. It always is, and this is really the just seeing it in real time. Okay, so we want you to be informed. We want you to know what we're thinking, and this will not be the last one of these things that we do. This is going to be a continuous discussion through this forum and others. But this is something that that we will work to continue to communicate. And as we feel changes are needed, we will make them or we will recommend them. Okay. So with that, I think that was kind of the bulk of what we had really prepared. And I know we're at about 40 minutes of actual talking time, which we could go for probably 40 hours and, just kind of to give real-time commentary as this stuff is as this stuff is evolving. But we do want to leave some time for questions, and one of them did come in, and it talks a little bit about the auto industry. And before I say anything about this question, let me say one thing. I know that a number of you on here are with GM, or have been with GM, and we also know that you are facing some specific questions, especially if you are still working. There are voluntary buyout offers and early retirement offers. Please feel free to call us if you want to discuss those things. We've already spoken with a number of people about this over the last few days since these things were announced. Please feel free to reach out. Okay. So the question that came in here, can you talk a bit about the auto industry and banking? Banks are increasing loan loss reserves. Repossessions are going up. Wholesale values and retail values don't seem to be following logic. Logic is a tricky word right now, I will freely admit. Manufacturers are intentionally keeping supply low. How has the last couple of weeks influenced the auto industry? And perhaps what might we be watching over the coming weeks? I have several thoughts about this. Is there anybody, Steve or Sonny or anybody, would you like to jump in and take this for first?
No, please go ahead, Mike.
So yeah, one of the things that kind of jumps into my mind with this question, it's a very good question, is, the auto industry has been suffering from a lot of the ripple effects of the supply chain issues that we've been dealing with for the last the last few years. And it's hard to say exactly. I don't know that this will tie it to banking necessarily, but the auto industry is going through a lot of transitions at the same time that they are having production issues, shortages in so many different areas, from parts to computer chips to you name it. The prices have been going up significantly. Again, supply and demand, right? Demand is what it is, whether it's going up or even staying the same. The supply is going down. So prices have been going up. And I think that it could get connected back to the banking industry, especially if perhaps new regulations or increasing regulations have to tighten the credit standards of these lenders, which could make it harder to get loans and could therefore, mean that there's, what that does, I don't know. Does that knock down demand because people are not able to get it? It's a great question, but there are so many interconnected parts of it that I think it's hard to say. I don't know that, and Steve, feel free to jump in on this. I don't know that what's going on with the banks in the last few days is directly impacting the auto industry at this point. I think that might not be a connection at this stage. I think that if these things really spread through, there could be more of an impact. So Steve, I don't know if you have anything else.
Yeah, I agree, Mike. I think the other thing that's going to impact auto companies is that, after COVID, younger people became a much larger percentage of the people taking out auto loans. And recently there's been a spike in delinquencies from younger borrowers. So younger borrowers having significant difficulties paying for anything these days because their costs are increasing. And auto loans on average make up almost 20% of their after-tax income, in many on average, for I think between 18 and 30-year-old or 20 and 30-year-old borrowers. So that's an issue as well, how that's all going to play out as the economy slows. And right now employment is very strong, but again, we'll see how strong that remains.
Yeah, and I think that's an important point too. We still have that underlying question of are we going into a recession, and will what's going on, will this maybe accelerate that process or make it more likely that we will? We don't know yet. We may be in one now. A recession is not a subjective thing. Many of you have heard me say these exact words. It is a measurable event. And so you don't really know that you're in one until you've had a couple of quarters of certain types of economic activity, and we can go back and say it. But if we are in a recession, we are in quite possibly the weirdest one in history, because one thing that it doesn't have is unemployment. There are a lot of reasons for that, but right now, people who want to work generally have the ability to do so, and therefore we haven't seen a whole lot of things coming down to delinquencies or huge spikes in bad loans. So you're right. The person who wrote this question, the banks are increasing their reserves for this, meaning they're prepping for things to get worse. But when or how that happens, time will tell. One other quick thing that I want to connect to that idea is that a lot of times we've been in this downturn really since from the markets from the beginning of 2001, or excuse me, 2001. Sorry, 2022. But a lot of times the actual beginning of a recession is actually often the signal that the damage is done to the market. Remember, the recessions are what we call lagging indicators in many cases. It's not visible until things have been ugly for a while. Markets are leading indicators. Markets move based on expectations. Just because we are in a recession doesn't mean that the market keeps going down. In fact, historically, they go up more often than they go down during the actual time when a recession is measurable. And when they have pulled back, this goes back to World War II, when they have pulled back, it's been by an average of a single-digit percentage number. So I don't want to say that we're hoping for one. We're not. But if it happens, it's often the signal that better days are ahead for investment markets. So that answer went in about 19 different directions, and I don't know that it directly covered it, but hopefully that gives you a few thoughts. So a couple more questions have been coming in. What move should we make if our auto lease is expiring within the next 4 months? Should we buy pre-owned and certified, lease pre-owned, buy new, lease new? Monthly lease payments have steadily increased over the last couple of years. That's one where I think that there's going to be some general things we can say about that, but I would encourage you to talk to us about that individually as well, because if you have that question, there are some, I think, personal factors that will go into that ultimate decision. But we know that prices are probably not coming down in the short term, whether it's new or used. The supply is still pretty screwed up. I don't know whether there's a fantastic answer to that question that is extremely desirable from a financial standpoint, but I would suggest that you give us a call on that one, because that answer might just be a little bit more specific for that we want to make it for a group. Okay. Next question that came in: will a recession affect the construction, building, engineering industry? Will development slow because of bank failures? Is it a good time for government engineering organization? Or hang on a second, I've got something blocking my. There we go. Good or bad time for government engineering organizations versus private organizations, both for hiring and development projects? It's a fantastic question, and Steve, you probably know stats on this off the top of your head better than I do. But construction, building, and engineering industry, I mean, certainly if there are a wave of bank failure, Steve talked a minute ago about how the importance of community banks in the financing of projects. Now, they're not going to be financing, $5 billion, high rises in the middle of Manhattan. But when we're talking about other types of development, yes, if there were clearly, if there was a huge impact on the regional banking industry, would there be collateral damage across things like development? It's hard to say no to that one. Whether we're talking about big engineering projects, I don't know how much of a direct impact there would be, because they're not going to be exposed to those same kinds of financial institutions in the same way. But in terms of hiring, development, I think most of these places are desperate for workers. They've been desperate for workers. They are desperate for workers, and they will probably continue to be, even if things slow down a little bit. I think that their pent-up demand for in so many industries for workers would still, outside of a few things like big tech, who probably overcooked it when they were hiring people, especially during the heat of the pandemic. Most industries are still looking for people, whether it's government fueled, whether it's privately fueled, whatever it might be. So yes, I think there could be some impact. But again, I think that assumes that there's going to be fallout from the banking side, that I think we can still say is somewhat unlikely.
Yeah. If I could, Mike, real quickly on that one too, is that if you maybe we take shorter term, medium term, and longer term. In the shorter term, everything Mike just said is going to be a headwind to growth. 80% of the commercial real estate loans are made by those regional banks. 50 to 60% of the industrial loans are made by those banks, and that's all slowing. Standards are going to get strict. Regulations will probably come in that probably make it even more prohibitive to do that. And then we'll have to find alternative lending sources to come in. Typically, those alternative lending sources are more expensive. And so, so that could be a headwind. But in the medium term to longer term, there is, Andy talks about, we talked with Mike about, is we really feel the next decade is the decade of North America. In the fact that we have a lot of, we lost our manufacturing for whatever reasons. We are now providing strong incentives to bring a lot of that back. And then if you look at the IRA Act that was passed, the Inflation Reduction Act, regardless of its impact on inflation, it's probably the opposite. It's probably going to increase inflation. But what it does include is a 30% investment tax credit for companies in certain focused areas that move back, develop these critical technologies, materials, and infrastructure we need in order to move forward within whatever more sustainable energy sources we come with, but also it impacts other areas. So that too, over time, will be a huge economic incentive for companies to locate here in the US or even in North America to really take advantage of that investment tax credit and develop those capabilities. And that, we think, could be a strong tailwind over the next decade for the US and North America.
Yep. Thanks, Steve. There's one other question that came in. I'm going to put you on the spot here, but I know I can because we talked about it. We've talked about it in the last few days. Our friends at Comerica have been in the news quite a bit lately. Comerica is technically no longer a Detroit-based bank. They moved their headquarters a few years ago, but they still have a huge presence here. And Comerica has been at the top of some headline lists lately. And it's funny, I've read articles that talked about them being one of the strongest in this position for some of these things, but they also were blasted pretty heavily. They were down more than 50% in a day. And I know that you've looked at that one in a couple of other areas, or a couple of other ones in the regional banking space. Can you talk about Comerica a little bit?
Sure. I think Comerica and other banks like that, are all being scrutinized right now. And I think actually Comerica was up earlier today. I'm checking it right now. Yeah, let's see here. I think it's So unlike other banks that are, getting hurt, that one is staying a little bit more resilient in this current environment. Obviously, it's down a lot over the last week or so. And what happens is everybody is scrutinizing these banks for the issues Mike talked about earlier that impacted Silicon Valley Bank. So even if they have simple, easy to understand, highly liquid, safest investments you can invest in, if they're mismatched, if one is a long-term investment you have to hold on to for a long time, and that's your asset, let's say, and your liabilities, your depositors are short-term. If there's a big mismatch there, that could have significantly negative issues that these banks have to deal with. So all these banks, they're looking at different capital ratios. If you take into account marking to market some of those securities, and on those measures, banks like Comerica and don't look all that good. However, they are very, as Mike said, they're not like Silicon Valley Bank, where Silicon Valley Bank had one pretty much type of client base. Comerica is much more diversified and really probably doesn't face those same issues. And that's why it's trading the way it is today. Most likely, as people have said, it's probably going to be a little bit more stable, but we'll have to see as we go through this. What I think what we know is we don't know when the next shoe is going to, as rates have risen, all that easy liquidity that was prior in the past had to get moved into something. How are those now as rates have come up? What disruptions are going to be created across balance sheets or business models that have not yet been reflected? And that's what Mike and Sonny and the team and we all are looking very closely into. But being diversified is probably the key right now.
Yeah. Another question just came in, and I think it's a phenomenal question, and I want to make sure we talk about this because this is one of the biggest ones that's being asked in general right now. So the question is, does this not encourage more risk taking? The actions of the Fed by backstopping the depositors, does this not encourage more risk taking from these regional banks and from the executives at these regional banks? And aren't these the same executives that lobbied and obtained less legislation in 2018? And are they being rewarded for that behavior? And the other question was, has Chuck the man, Schwab, been made whole on his $3 billion at SVC? Let me answer that one first. The answer is absolutely no. Okay, and these answers are kind of connected here. First off, Chuck didn't lose $3 billion through the Silicon Valley Bank. He only lost about $1 billion, but that was in stock. And the answer is absolutely not. He was not made whole. That's gone. Now, the $3 billion that he lost $3 billion partly because the value of Charles Schwab, the corporation, came down in the short term. It's come back up since. So I think Chuck will stay out of the soup line. He's probably back to 11 or 12 billion now. But the portion that was he didn't lose money because he was a depositor in Silicon Valley Bank. He lost $1 billion because he owned $1 billion worth of their stock. At least that's what we've been told. So no, he was absolutely not made whole on that. And the point about executives and risk taking is a really important one. I would argue that the answer is no, they're not being rewarded for this. What's happening is that the depositors are not being penalized for this, okay? But all of those executives that had all that stock, yes, maybe they cashed out, and some of that's coming. It's already come out that their CEO did cash out at least a little bit of it. But those people who held huge amounts of stock and value in those companies, that value is gone. So they have lost an incredible amount of wealth. Now, I'm not crying for them, and I don't think anybody else is either. But there are some very real repercussions here that, frankly, were not felt in 2008 by many of those executives. Yeah, their value went down, but their stock didn't go to zero. Those stocks are still there, and people who held on were frankly not punished all that severely from a financial standpoint. And that's something that I think will be debated until the end of time. But the executives, I think personally, are going to be feeling a significant amount of pain here. And they're all out of a job, first off, in those particular banks. They were all fired when the new bank came in. And I think they are going to feel pain in the future in the form of significantly increased regulations that are going to stop them, or not stop. I don't want to sound that's not the right word. That are going to attempt to rein in all of those types of behaviors. So it's a very good question. But I think that this is another one and another example of how this is different than what happened at that time.
And if I could, Mike, on that point, if you think about it, what impact could this have down the road? Again, it's those regional banks that are providing, are doing things that typically the larger banks are not.
Right.
And the larger banks are not because after the 2008 crisis, the regulations became so onerous on those larger banks that they really had to move, just don't do business that they don't do a lot of different types of business. So that, so if now what Mike said, happens, now we have more regulations come in on these regional banks. Well, again, they're the ones who are providing huge amounts of lending to our economy. And again, it's the lending, the borrowing that helps people, helps the economy grow, helps hire people. Now it can go out of whack, things can get too crazy one way and then you have problems. But likewise, if it restricts things too much, then we have problems in the opposite direction.
Yeah, absolutely. But yeah, so the other part of that question that I don't think I answered directly, weren't these the same people that lobbied to get this legislation? Absolutely, yes, without hesitation. In fact, it was some cases the exact same individuals. In fact, the CEO of Silicon Valley Bank was one of the people who testified in 2018 to get these regulations reduced personally.
Now, I will say the regulations were different for smaller or medium-sized banks and larger banks, but they're still regulated. I think if you look through this was a failure at a lot of levels. Clearly, management, the CEO and CFO, horrendous here at Silicon Valley. This bank never should have failed, but it was also a huge failure of the regulators. This information was available last year, earlier this year. How nothing was done to prevent this is shocking.
Yeah. So yeah, it's again, this is going to be dissected for a long time. When somebody's saying that Silicon Valley had no risk manager in place for over a year, that's true. I've read that too, and but I would say that type of risk shouldn't, or this wasn't a small bank. Okay, this wasn't one that had 5 or 6 people who were all busy doing other things. Not having a risk manager shouldn't mean that there was that type of lack of attention to the balance sheet. So yes, by definition, that role would cover it. But I don't think that I don't think that the regulators are going to take that as an excuse, even though, as Steve correctly pointed out, there's some blame to go around for the regulators as well. So the credit union question, I know a few people, it's popped out here. So does what is happening affect credit unions as well? Again, it's hard to give one blanket answer that would cover all credit unions in the same way, but I think that it's very safe to say that the structure and business operations of most credit unions is significantly different than a bank like certainly the size of Silicon Valley. Most credit unions are obviously not anywhere close to that. It's a completely different approach. It's local, it's regional. They are regulated as well, but it is very, very hard to extrapolate those kinds of problems all the way down to most credit unions, even larger credit unions like what was in here. They talked about MSU Credit Union, which is one of the biggest ones out there. I know there's a lot of MSU people on the call today. Because so much money from Michigan State University is there. Again, I can't speak to their financials. I wouldn't say that I understand I don't have their balance sheet in front of me, and we would need to do a bigger dive into it. But again, I do not think that it is a natural progression to say, okay, problem here will automatically equal problem here. Those are significantly different types of financial institutions. And I'll tell you the other thing. I don't care if you are in any kind of business, any kind of bank, big, small, credit union, you name it. If the last couple of days wasn't a wake-up call to take a little bit closer look at your books and how things are positioned, I don't know what else it's going to take. So I think that this is going to be something where responsible institutions will keep doing what they've been doing. They will keep being compliant in the way that they have been compliant. Other places that have been maybe a little bit further out on the fringes either are going to do this voluntarily, or they're going to do it kicking and screaming, but I think they're going to get there. And these regulations will apply to banks at lower asset levels than they do currently. So one question is kind of a clarification. So Silicon Valley taking a safe approach with long-term bonds was essentially a big risk. The answer is absolutely yes. The reason why it was a risk is because the value of those bonds, because of where interest rates were, the value of those bonds essentially only had two options. They could stay the same or they could go down. They really couldn't go up because rates really couldn't go down any further, right? Remember, that's how that thing works. So yes, on paper, they are safe, and they're safe investments, but the value can fluctuate over their lifetime pretty significantly. So if you have to sell them, and in their case, they were forced to sell them to get the cash, then those paper losses became real. So yes, essentially they were subjected to a significant amount of interest rate risk that they could have avoided by being in a different position with the bond portfolio. Okay, so it wasn't a risk. It's not a credit risk. All right, if it's a credit risk and the United States government goes out of business, well, we all have bigger problems. Okay, but it wasn't credit risk that they were taking. It was interest rate risk, and it was significant. So I know we've gone a long time here, everyone, and I know some people have dropped off, but a lot of you are still here, and I appreciate that. I want to wrap this up. I know some of you may have other questions. Please feel free to reach out to us. But I want to leave with one thought, is that and it kind of gets back to the point I was making about, even are we in a recession? Are we towards the end of this? There's a lot of negative news out there. There's always a lot of negative news out there. That's what our media sells. And a lot of you have heard me rail against this for many years. There's a lot of things out there, and there's a lot of reasons to be negative. Remember, nothing keeps eyeballs glued to a screen better than outrage and fear, which is what a lot of these places sell. Okay, and these news agencies that are ratings driven do this. So we want to say that we know that there's going to be volatility. We know that things might get ugly in the short term here, but we are very excited about investment prospects in the long term. What Steve talked about, you will hear this phrase from us again, that the next decade is the decade of North America, not just the United States, but North America. We think a lot of things are going to come back, a lot of manufacturing, a lot of things that have been moved overseas over the last few decades with the push towards globalization are going to revert back. there's a lot of things and a lot of opportunities and a lot of investment opportunities built around these things. But in the short term, we know that things can get a little bit ugly. Okay. But there's a lot of reason for optimism, we believe, even in the short term, and a lot of this pain, we think we've worked through, and we will see the outflow of that here soon enough. So so a couple of other comments coming in. Our accounts at Schwab, the one thing I do want to address real quickly, there's a question about protection at Schwab brokerage. Our accounts insured to 250 or 500. That's a different kind of insurance. That's what's called the SIPC, Securities Investor Protection Corporation. Insured, they are. However, that is that's not about performance. Remember, that's not about ensuring that values stay where they are. What that is insurance against the failure of the custodian itself that might impact the accounts. So yes, there is SIPC coverage for Schwab, and any legitimate account at any major brokerage or a custodian will have that. Okay, so the last question here is now the time to buy bank stocks? It may very well be, but now we're talking. You got to be very careful. And I think any bank stock that you buy is going to. We talked about volatility. I think that volatility is going to be ultra concentrated in that sector. And when you're buying individual stocks, yeah, it's possible that you can buy one bank and that might be the next one that's in the news, and nobody wants that. So there may be opportunities in there. It's something that we are talking about behind the scenes here. But is that going to, is this the perfect time? Time will tell. I think if you're looking truly long-term, it may be a very good opportunity. But there could be a lot of bumps along the, not could be, there will be a lot of bumps along the way. And the tech correction, again, this is, I'm trying to cover these as quickly as we can. The tech correction, and there's so many things that we could talk about with that one. Is something that, again, I think we would speak about individually. Tech companies, you're seeing it a lot. You're seeing a lot of job cuts, especially in the big tech names. I mentioned this a second ago. I think a lot of that is because they hired too many people, and especially there was such a race to hire everybody, so that I think in some cases just so other people didn't hire them or other companies didn't hire them, and they left themselves it was overdone. Okay. So the tech stocks are also, remember this, they're vulnerable to interest rates, right? Because they're capital intensive businesses. Many of them are still borrowing. That's why tech names got hit first last year, when interest rates really started to jump. But when we talk about long term, the tech industry is a huge part of that. We're talking about things like automation and security, and yes, even things like artificial intelligence, and speaking of things that are getting a lot of press right now. But the tech industry is obviously integral to all of these things. Tech industry is not going anywhere, but I think they have to kind of settle out some of the things that they overcooked over the course of the last couple of years. So that's way too short of an answer for that one, but hopefully gives you a little bit of an insight into kind of our overall thinking. So so anyway, if anyone else has questions about the specifics, especially if it relates to Schwab or the coverage that is there. By the way, one other detail about Schwab that I should mention: if you have Schwab accounts, all of you will see that there's a portion of your account that it's listed as bank sweep. It's actually in a money market fund. this gets a little confusing, but remember how I said a minute ago that there's SIPC protection across the whole account? That's true. The default money market fund, where a little bit of your account is held, that's actually an FDIC insured bank product. Okay, so there is actually FDIC coverage on the default money market fund alongside of the SIPC protection across the whole thing. Okay, so anyway, I again, we can talk about that in more detail if you have any more specific questions, but there are several layers of protection for all of these accounts, and that's not just at Schwab. Other places have this as well. So in any place where any legitimate place where an account is being held is going to have these types of protections. So certainly any place that the people on here, whether it's a 401k provider or whatever else, the SIPC is something that you would see on all of them. Okay. So all right, with that, I'm gonna stop this for now. And again, thank you all for coming on board with us today. A lot of stuff going on. If you have any other questions, one more time, please reach out to us. But thank you all very much.
Thank you.
Thank you, Mike. Thank you, Andy.